Welcome back to Talk Tickers. We're your cheat sheet for experienced investors, and today we're diving deep into TTEC Holdings, Inc.
That's TTEC, and specifically their second quarter 2025 earnings call. It happened back on August 8th.
And you're joining us because this wasn't just another earnings call, was it?
No, not at all. I mean, the market reaction was pretty decisive. The stock surged. It felt like, a real shift.
Right. It seemed like investors finally gained some clarity, saw some positive momentum building. This wasn't just a small beat.
Exactly. It felt like a re-rating event almost, a reversal after, quite a bit of underperformance leading up to it.
So our mission today is basically to unpack that. What did TTEC actually do right in Q2? And maybe more importantly, what did management say that gave the street this newfound confidence?
Okay, let's jump right into the hard numbers for the second quarter then.
Yeah, let's start there.
So revenue came in at $513.6 million.
Okay.
Which was, comfortably ahead of the consensus. That was sitting around $499 million, give or take.
And that's interesting because they were actually forecasting a year-over-year decline, weren't they? About 3.8%.
They were. So beating the top line like that, especially when you're facing those kinds of, let's call them secular headwinds, that's a definite positive signal.
Definitely. But where I think it gets really interesting strategically is on the profitability side.
Tell me about it.
Adjusted EBITDA, it landed at $51.8 million.
Right.
Which works out to a 10.1% margin. Now, that significantly topped what analysts were expecting.
And critically, that's a 140 basis point improvement in margin compared to last year.
Which, in this kind of BPO environment, business process outsourcing, that's been under so much pressure. Getting margin expansion like that is tough, really tough.
It absolutely is. And, while the non-GAAP EPS, the earnings per share, was $0.22, that basically met expectations. There was maybe a little noise, some analysts parsing slight differences there, but the market, I think, correctly looked past that.
They focused on the top-line beat and that margin progress.
Exactly. That margin expansion suggests, the cost controls, the internal stuff, it's actually starting to take root.
Speaking of controls taking root, cash discipline. Let's talk about that.
Yeah, the cash flow was pretty remarkable.
Free cash flow, FCF, was $85.5 million.
Yeah.
That's supported by, $92.7 million in cash from operations? Why is that FCF number specifically so important for a company like TTEC right now, given their focus on restructuring?
Well, FCF, that's the lifeblood, isn't it? It's what you use to pay down debt, to invest back into the business for the future.
Right.
Generating that much cash, over $85 million in just one quarter.
Yeah.
It shows that all those efficiency measures, the profit optimization things they put in place back in 2024, they're finally yielding actual cash, not just, accounting adjustments on paper, real cash. And that changes the whole narrative around the balance sheet.
That is powerful validation.
Boy.
Okay, so let's dive into the segments. Where did this profit momentum actually come from? Was it broad-based?
It was pretty solid across both main units, actually. Let's start with Engage. That's their core customer experience management stuff.
Yeah.
Revenue there was $399.8 million. Now, that was down 4.3% year over year.
Right, so still seeing some top-line pressure there.
Correct. But the operational win was clear. The operating income margin, it improved by 110 basis points.
And that comes directly from those optimization initiatives you mentioned.
Directly.
Yeah.
Confirms they're having a real structural impact, not just a one-off.
And the outlook for Engage looks decent too, right? The backlog covers, 101% of their updated 2025 revenue guidance?
Yeah, that gives them pretty good visibility going forward. Now, shifting over to digital, this is the smaller, more strategic segment.
Right.
Revenue there, $113.7 million, also down slightly, about 2.3% year over year.
Okay, but the margin story.
Yes. The operating margin was 16.1%.
Wow, that's a huge jump. What drove that?
It looks extraordinary, and we do need to add a little context there. It got a significant boost from a one-time IP software sale, $4 million.
Okay.
And that kind of sale naturally comes in at pretty much 100% margin. So if you kind of mentally strip that out.
The underlying improvement was more modest.
Exactly. Still real improvement driven by things like better capacity planning and getting more utilization out of their professional services teams. But yeah, that 16.1% number is definitely optically elevated by the one-time sale.
Got it. Okay, this brings us neatly to the bigger strategic picture. This digital-first strategy they keep talking about, heavily leaning on AI.
Right. The whole customer experience industry is grappling with AI, obviously. But TTEC management, they took a pretty firm stance on this call, and it kind of contradicts the the common fear out there.
How so? What's their angle?
Well, they're not just talking about using AI internally to cut costs, though they are doing that too. They're positioning AI as a tool for their clients that augments human agents rather than just eliminating them wholesale.
Lens, not eliminates.
And the CEO actually cited market research. I think Cavell was one source mentioned, suggesting that overall demand for contact center services is actually projected to increase by about 10% over the next 3 years.
Wait, hang on. Increase. In an environment where seemingly every tech pitch is about AI reducing headcount, TTEC is arguing AI will drive more need for humans, just maybe smarter AI-assisted humans.
That's the core of their argument. It's a bold counter-narrative, isn't it?
It really is.
Their thesis is basically AI handles the simple, repetitive stuff. That frees up the human agents, especially the really skilled ones, to deal with the complex, high-value customer interactions. It becomes about boosting productivity and quality, not just slashing costs.
Do they have any concrete examples? Like, how does this augmentation actually play out in practice? Does it win them business?
Yeah, they give a pretty good one. They talked about using AI-based accent neutralization technology.
Accent neutralization.
Yeah, for a big home improvement retailer client. Apparently, historically, clients sometimes push back on certain regional accents from agents in offshore locations.
Okay, I could see that happening.
So this AI tool, it sort of smooths out the communication, makes it clearer, and the strategic benefit for TTEC is huge. It lets them tap into new talent pools, highly skilled people in places like Eastern Europe or South Africa, maybe where costs are lower, but where accents might have been a barrier before.
So the tech directly enables their offshoring strategy. That makes sense. It opens up access to talent.
Precisely. And offshoring is critical for their growth and margin plans.
Okay, let's swing back to the digital segment's evolution. You mentioned they're moving away from huge legacy projects. They talked about CKS implementations. Can you unpack that a bit?
Yeah.
What is that, and why is shifting away potentially good for margins?
Sure. CKS just stands for Contact Center as a Service. Think of it like the underlying cloud software platform that runs a modern contact center.
Got it.
The implementations used to be these massive, complex, multi-year projects. You rip and replace a client's entire old system. They generated big chunks of revenue up front.
But maybe not the best margins.
Often not, yeah. Because they were complex, lots of integration risk, could be lower margin work. What management is emphasizing now is a shift. They're moving towards smaller, faster engagements that are specifically enabled by AI.
So fewer giant projects, more like quick wins focused on AI.
Kind of like that. Less whale hunting, maybe more landing these rapid, often higher margin AI-focused deals.
Okay.
Now, the trade-off is that these new contracts are smaller initially. That's partly why you see that short-term revenue pressure in the digital segment.
Right.
But management was clear. These deals carry higher gross margins.
Yeah.
And maybe more importantly, they act as beachheads.
Beachheads, meaning they lead to more work later.
Exactly. They get TTEC in the door with these high-value AI solutions, and that often leads to longer-term, recurring managed service contracts down the road. So they're kind of sacrificing a bit of near-term scale for what they believe is higher quality, more durable revenue in the future.
That makes strategic sense.
Yeah.
Okay, let's shift gears a bit. We absolutely have to talk about the big elephant that finally left the room.
Yes. The governance situation.
Which arguably had a massive impact on the stock's performance after this call.
You really can't understand the stock move without addressing this first. So August 1st, right before the earnings call, the CEO formally withdrew that take private proposal he had floated. It was for $6.85 per share, remember? It had been hanging out there for nearly a year.
And it created this huge overhang, right? Yeah. Uncertainty about the company's future, strategy.
Massive overhang. It was like this psychological anchor dragging the stock down. So once he withdrew it, and the board came out affirming their confidence in staying public, poof, that uncertainty just vanished.
Clarity. That was absolutely key. But, clarity alone isn't enough. Investors needed to see results to back it up, and the financial turnaround, especially on the balance sheet, really seemed to deliver that proof.
Oh, definitely. The deleveraging trend in Q2 was, frankly, aggressive.
How aggressive?
Net debt decreased by $78 million just in the quarter.
$78 million. Wow.
Yeah.
Driven by that strong free cash flow we talked about.
Directly. And here's the metric that really matters for investors watching the debt. The net leverage ratio, calculated under their credit facility terms, it dropped substantially.
Okay, numbers.
It went from 3.79 times EBITDA in Q1 down to 3.39 times in Q2.
So a 40 basis point drop in leverage in a single quarter. For context, why is hitting that 3.39x number so significant right now, especially coming down from where they were?
Because it signals they are moving fast towards what the market considers a much healthier, less risky balance sheet. Remember, they peaked way up near 4.5 times leverage just last year in Q3 2024.
Right, that was getting concerningly high.
Exactly. So getting under 3.5x and heading towards 3x, it shows intense focus on cash generation and debt paydown. It gives them more financial flexibility, it reduces their exposure to rising interest costs, and it just signals discipline to everyone: lenders, bondholders, equity investors. It's arguably the most critical operational achievement of this quarter.
That's a really strong point. Okay, looking ahead then. Management raised their full-year guidance.
Yep.
Revenue midpoint now $2.089 billion. What's driving that confidence? Any catches?
The raise seems to be mostly driven by embedded base growth within that core engaged segment, basically holding on to existing clients and selling them more services, which is good, stable business.
Okay. And the catch?
The main caveat is foreign exchange, FX. They're actually getting a bit of a tailwind on revenue right now because the US dollar has weakened. So when they convert their foreign sales back into dollars, they get more dollars.
Ah, a revenue boost from currency.
Right. But management was upfront about this. That same FX dynamic actually hurts their margins compared to their internal budget because their costs in those foreign locations, when translated back, are effectively higher in dollar terms.
Got it. So revenue up on FX, but margin pressure from the same source. Important nuance for anyone tracking profitability closely. Okay, finally, let's touch on the cadence for the second half of the year, because it's not just smooth sailing from here through Q3, is it? They guided for a bit of a dip.
No, that's right. They were clear. Expect Q3 profitability to dip temporarily.
Why? Is that a bad sign?
Not necessarily. It seems to be a deliberate strategic choice. They're making significant investments right now in Q3, specifically to ramp up for seasonal U.S. healthcare volumes.
Ah, the big healthcare enrollment season.
Exactly. And they anticipate those volumes will be substantially higher this year. So they're spending money now hiring, training, getting systems ready to handle that surge later in the year.
So it's like taking a planned hit in Q3 to make sure they can capture all that high-value healthcare work effectively.
That's the idea. They expect these upfront Q3 investments to lead directly to a big rebound in profitability and strong year-over-year growth in Q4. It's a purposeful ramp. They're flexing their operational muscles to grab that lucrative seasonal business, which should also set them up for a stronger start to next year. But you're right to flag it. Investors need to watch closely. That Q3 investment has to deliver the promised Q4 payoff. That's the execution test.
Makes sense. And just connecting back quickly to this focus on offshoring. They're targeting, what, 37, 39% mix for the year? And using those AI tools we discussed? Where are they finding the talent?
Yeah, they confirmed the majority of the sales pipeline, the new business, is focused on offshoring. And they're strategically expanding where they source that talent, looking for highly skilled agents capable of complex work.
Beyond the traditional spots.
Yeah, specifically calling out places like South Africa, Egypt, and parts of Eastern Europe, which again highlights why those tech investments, like the accent neutralization, are so important. It lets them scale globally while trying to maintain quality for clients.
Okay, great context. That brings us to our favorite segment. This is not financial advice.
Yes, where we synthesize all this info into maybe an outrageous but plausible trade idea, based purely on what we heard in this deep dive.
Absolutely. High conviction, maybe a little provocative. So what's the pitch this time?
Okay, prepare yourself. This one is anchored directly in that investor psychology piece we discussed, combined with the financial rigor they demonstrated.
I'm ready.
The pitch is a long position in TTEC, and the target. It's reaching that psychological anchor point, the $6.85 per share from the CEO's withdrawn take-private offer.
Interesting. So the stock obviously surged after the call, but it's still way below that $6.85 level.
Way below. And look, that $6.85 offer, whether it was ever truly executable or not, it represented an implicit valuation, right? An intrinsic value suggested by an insider, the CEO himself.
Okay.
So the trade thesis is basically this. The stock, until recently, was trading like a deeply troubled, maybe broken BPO company. High debt, uncertain future. But this Q2 call, it provided strong evidence that TTEC is rapidly transforming. It's becoming a cash-generating machine. It's aggressively deleveraging. It's pivoting to higher-value AI-enabled services. It's moving up the food chain.
Okay, but the skeptic immediately says, what about execution risk? What if that Q3 investment doesn't pay off in Q4? What if the top line keeps shrinking faster than expected? How do you justify aiming for $6.85?
That's the right question. And the mitigating factor, the core of the thesis, is that relentless deleveraging trend. The catalyst for closing that gap between the current price and $6.85 isn't hope. It's operational execution forcing a market re-rating.
So as they keep generating strong free cash flow.
Exactly. As they keep paying down debt, as that leverage ratio keeps ticking down, and crucially, if they hit that targeted 10.8% full-year adjusted EBITDA margin they guided towards,
then the balance sheet risk evaporates.
it significantly diminishes. It removes the primary reason the stock has been trading at such a low multiple. So this trade is essentially a bet that the market has to eventually reprice the company based on its improving financial health, its accelerating cash generation, and the removal of that governance uncertainty. You're basically going long the return to that previously defined, albeit withdrawn, marker of intrinsic value.
That frames the argument very clearly. Okay. Let's recap the main takeaways from this deep dive then.
Sounds good.
First, TTEC delivered a strong Q2 beat, especially on profitability, driven by those optimization efforts finally bearing fruit.
Right. Second, powerful free cash flow generation. That $85.5 million is key.
Which leads to the third point.
Yeah.
A clear and impressively rapid path for reducing leverage. Getting that debt down is huge.
Absolutely. And fourth, that strategic pivot, moving towards higher margin AI-enabled services, but with this interesting twist of focusing on augmenting humans, not just replacing them.
It feels like the whole narrative arc for the company has shifted, doesn't it?
I really think so. It's moved from defense restructuring, uncertainty, putting out fires to offense, rebuilding towards sustainable double-digit margins and focusing on growth, but growth driven by these smarter strategic investments.
So for you listening, the key things to watch going forward are probably that deleveraging trajectory. Does it continue at this pace? And critically, how well management executes on that Q4 profitability rebound after the Q3 investment.
Yelled it.
All right. Remember, everyone, this content is purely for informational purposes. It is definitely not financial advice. Please do your own research.
Always.
We'll catch you on the next deep dive from Talk Tickers.